And this video is being recorded on the early evening of Wednesday, August 23rd, 2023. Thank you so much for tuning in. And in this video, I'm going to go over something which I kind of covered in lesson 3 in the Daily Gold University, but it's how everything, all these things are related right now. And, we're in the midst of, potentially I could say, but in the midst of a major change in the secular cycle as far as secular trends. And so I've been talking about, we need the stock market to go down. In recession, stock market loses its 40-month moving average. Then you're in a secular bear. Gold can go up. Yes, that's true. But the dollar and bonds also come into play. And so, just one chart in this video. I'm going to speak a lot. Well, hopefully not too long. But we have the S&P here, the dollar. This is a total return calculation. I contracted someone. We had the historical data, so they did that for me. Then we have gold. And so these vertical lines show when the S&P lost its 40-month moving average. Just to provide some context, that hasn't happened yet. The S&P, it's been last year, it held above the 40-month, tested it a few times, hasn't made a new high yet. It kind of looks similar to here. In the late 60s, where, the Dow peaked in 66. This was the distance from the 66 peak to the 68 peak, end of 68, I think was only like 30 or 50%. It was really not that much. And so this could be something similar, especially if we have a recession, I want to say in the next, say, 12 to 18 months. It's which looks likely to me. It's not going to be a real cyclical bull to write home about. And who knows? Maybe maybe the downturn's starting much sooner than that, or maybe it's starting right now or a week ago or whatever. But anyway, so what's the relationship of the dollar to all this? Well, the two secular bears in the dollar, they coincided with the secular bear in stocks, and so here, the stock market and when it lost the 40-month moving average, those things happened before this peak in the dollar. Now, I don't know if it's going to repeat exactly, but the point is, if the stock market is going to, pretty soon lose the 40-month moving average because we're going to have this recession and the Fed's going to have to cut rates and the government's going to have to spend money and, printing is going to have to come back. Then you have the dollar is obviously going to go down in that scenario. But again, that's because you'll have the S&P falling below this moving average and confirming a new secular bear. And so, here and now, it's just, saying the dollar has made this major peak right here. There's not enough evidence to make that call. And the other thing is we know, gold leads the dollar at major turning points. So whenever gold breaks out and has a big move higher, which, to me, that will happen when we have a recession and the S&P falls, because then the market will sniff out the rate cuts and the printing. And whenever that's going to lead, that will, the dollar, you get the breakout, the dollar follows that move lower. But anyway, back to the big picture, it's all related. And so where do bonds come in? By the way, let me mention this before I forget. This is the 80-month moving average for the total return of bonds. And look at how bonds held above that from 82 all the way basically to the last year or so. So, that's a potential indicator of a new secular bear in bonds. And, interesting, if you go back to this peak in bonds, I think it's, this peak in 66 here of the total return, even though the total return went higher and you were still making some money in bonds nominally, that's true. But this peak from 66, all this low here in 80, that's actually 15 years. This is how bad it was for bonds, the end of the 70s and early 80s. This was 15 years of nominally no return on bonds. And think about all the inflation that transpired during this 15, almost 16-year period. So bonds were an absolute disaster in that scenario. But, how does this apply to here and now? Well, bonds bonds went into their rates or bond yields. They really started moving up significantly before the S&P made this peak. And so you can see the total return. It went up a little bit, but it was basically, more or less kind of flat. You got nothing with respect to, when you're factoring in inflation. So bonds, the bull market in bonds, it ended first, and, the market peaked. And then, this is kind of artificial with the dollar. Gold had already, it didn't, but you see the relationship. Bonds peaked first, stock market peaked, and eventually the dollar fell. So, again, where are we here and now? Not yet for the stock market. Still holding above the 40-month. So we can't call a major peak in the dollar yet. But bonds, that's the one big thing, is that the bond market has really turned. And so, if we get a recession, if there's a recession coming in the next 6, 9, 12 months, whatever, you'll get a rebound in bonds. Interest rates will go down, bond yields will come down. And so you'll get a rebound. Total return will rise. So that'll be a good period to own bonds. But, after the recession passes, the total return will fade. And, then it could, if inflation turns up again, in 2 or 3 years, that could, it could follow this pattern. So that's how all these things are related right now. And we're not, we could be at the secular turning point, or maybe it's going to take another year, but it's just important to really understand how all these things are related. And so to me, the leader is really going to be the stock market, because we know that gold leads the dollar at major turning points. And we know that if the stock market keeps rising, gold can't really break out. Maybe it can break out a little bit or go to 2,300, but if the stock market keeps rising, you're not going to have that new real bull market in gold. So you need the market to fall below the 40-month moving average, have a real bear market. You need the recession, blah, blah, blah. But, it's true. Because when you have that happen, you have a new secular bear, gold makes this big breakout, then all this capital is going to start moving into gold, silver, more into hard assets. But if the S&P is going to go like this and hold above, and you don't have enough of a recession, it goes like this, all that money is going to go into stocks. It's not going to go into gold, and gold will struggle. I don't think that's going to happen, but I'm just putting it out there just so we can better understand it. So let me know what you think in the comments. This is something that was on my mind today. I was also thinking about bonds. So there it is. Let me know what you think. Leave a comment, and I'll talk to you guys again in the next video.